Hi everyone, thanks for tuning into my channel, All Things Accounting. Today what we're going to be talking about are bad debts at expense and allowance for doubtful accounts. So stay right there and we'll get through this together. So, welcome to my office. It's a little messy if you could see. Actually, it's pretty messy. I apologize for that. So I just want to bring you guys in here because I want to make an example of this iMac here. I bought this a couple of years ago for a nice chunk of change. It's a very good computer, and it was fully paid off at that time. But I just want to use this as an example. Let's say that companies make sales of goods or render services. They want to ideally collect everything that's legally owed to them. Sometimes customers may not be able to do all that and pay off everything or pay off a certain percentage or dollar value of the balance owing because for a variety of reasons they may be in financial difficulty, they may have declared bankruptcy, or they just don't want to flat out pay. So what are the accounting options for companies when they have to account for such things on the books? So we'll go through that. So when a company makes a sale on account, normally what they would account for, let's say for example this is a sale of particular goods or physical goods. So normally if they make a sale, they would debit accounts receivable if they made it on account and credit revenue. Now, as we mentioned before, what are the options if a particular customer or company cannot pay? Either they choose not to pay or are encountering certain financial difficulties, so they're trying to work it out, and therefore they may come up with an agreed upon percentage or dollar value, so that's forgivable. So what happens is that there's something called the allowance method. And so what this allowance method allows is that it satisfies the matching principle under generally accepted accounting principles by matching the expected losses from an uncollectible accounts receivable against the sales for which they help to produce during that period. So in this case, it's not an exact science, it's an estimate. Okay, it's an estimate. And this estimate can be based upon prior experience with the particular customer or other similar customers in the past. So they use that as a benchmark. And these are recorded at the end of the accounting period. Now let's run through a numerical example of this. Let's say on December 31st, ABC Company still has about 20,000, we'll designate 1,000 by K, of credit sales that are still outstanding, or in this case deemed uncollectible. It still may be able to recover it. Companies usually want to still give their customers a chance with time, and therefore that eventually gets into aging of accounts receivable. The longer you leave it on accounts receivable on the books, then the less likely that it will be able to be collected. And that's another topic in itself when you're talking about aging of receivables over 30 days, 90 days, 60 days, and so forth. So it estimates that approximately 1,500 of this is bad debt. So therefore, on December 31st, what they would have to do is they would debit bad debt expense, and credit allowance for doubtful accounts for $1,500. And of course there would be the explanation underneath there. Now notice that this bad debt expense here, that would be hitting the income statement to lower your net income. This allowance for doubtful account is a contra asset account where it would be shown on the balance sheet right underneath the accounts receivable and subtracted from there to give you a net balance. Okay, remember that balance sheet accounts are permanent accounts. It always stays there, whereas income statement accounts are temporary. It always gets closed out to the income summary at the end of the period. So here, if we were to look on our balance sheet, let's say, under current assets, because remember current accounts receivable is quite liquid, so it tends to be easily converted to cash. You have accounts receivable, 20,000, and then less allowance for doubtful accounts of 1,500, and therefore the subtotal here would be 18,500. So even though the 20,000 is legally owed to ABC, only 18,500 is realizable, is a realizable value. That's how much they can only collect. Now let's go to the scenario where we are writing off bad debts. So what does that mean? That means that where certain scenarios where we are unable to collect accounts receivable, we deem that to be based upon, again, past experiences. We know for certain, let's say we calculated that there's a certain percentage that we cannot collect from that particular customer, then what we have to do under fair presentation for usefulness of financial information, we have to reduce our accounts receivable by that amount. So, in this case, we have to write it off against allowance for doubtful account, and it has to be removed from the accounts receivable. So, example, from our previous example, let's say that ABC company decides to write off approximately $520 at after year end. So let's say on January 23rd. So in this case, the January 23rd journal entry would have to be debits, allowance for doubtful accounts, and credit accounts receivable of $520. So if we were to look at the T accounts for both the accounts receivable and the allowance for doubtful accounts. So here on December 31st, there's 20,000. We made an allowance on over here on December 31st for 1,500. Now on January 23rd, we're writing it off of $520, January 23rd. So January 23rd, $520. Now, what's the net impact on this? It's a net credit balance for the allowance for doubtful accounts on January 23rd. And then if we calculate this, it would be a balance of of 19,480. So let's look at this. Before we write off the amount, and after write off, let's look at the impact of it. If we look at our balance sheet, accounts receivable, here we had $20,000 and then less allowance for doubtful accounts, and that was $1,500. That yields $18,500. Now, after we write off the allowance for doubtful accounts, the bad debts, then the accounts receivable would be reduced to $19,480, and accordingly, the allowance for doubtful accounts would also be reduced to $980. So the net impact of this is still $18,500. It's the same, but it's just that we're reducing an asset account, and we, at the same time that we're reducing an asset account, we're reducing a liability account as well. So I hope this example helps you, this tutorial. If you liked it, I hope you have a little more insight on bad debts expense, how to write it off, what allowance for doubtful accounts is. So please remember to subscribe to my channel, hit that like button, and hit that bell notification icon so that you are always up to date on my new tutorials that I'll be posting in the future. Until then, take care.